Okay, let's dive into this. We're going to look at one single line item on a financial statement that, believe it or not, can reveal some of a company's biggest secrets. We're talking its health, its failures, and sometimes even its honesty. And yeah, it all comes down to inventory.
It really does seem like a paradox, doesn't it? I mean, how can a brand new product still in the box be worth less today than it was yesterday? Well, imagine a new smartphone is about to be launched. The second that announcement hits, every single one of the older models, all those phones still sitting in warehouses, they instantly lose value. The market has simply moved on, and the rules of accounting say you absolutely cannot ignore that reality just because you haven't sold the item yet.
And this gets to the absolute core of the whole thing. Accounting can't just live in some fantasy world where things are worth what we wish they were. Nope, it has to reflect the cold, hard reality of the marketplace. So that gap, that space between what a company paid for something and what they can actually get for it right now, that forces their hand. They have to make an official entry called an inventory write-down.
Now, to handle this exact problem, accounting has a foundational principle. And look, while it might sound pessimistic on the surface, it's actually a crucial rule. It's designed to protect investors and keep financial reports firmly grounded in reality.
This right here is the key. See, conservatism isn't about being negative. It's all about being realistic. You can think of it like a safety mechanism. It forces companies to acknowledge probable losses immediately, which stops them from pretending their assets are worth more than they really are. It's what keeps the financial statements honest. So this principle sets up a really simple showdown, a comparison. On one side, you've got the historical cost. That's just what the company originally paid for the stuff. And on the other side, you've got the net realizable value, or NRV. Basically, that's a realistic estimate of what they'll pocket for it after all the costs are paid. The rule is dead simple. You must report whichever number is low.
And here's where things get kind of interesting, because the rules are not the same everywhere. As you can see, under the US rules, what we call GAAP, a write-down is a one-way street. Once that value is lowered, it stays lowered, period. But under international rules, or IFRS, if that inventory's value actually bounces back, companies are required to reverse the write-down. It's a huge philosophical difference, right? The US system locks in the loss to be extra cautious, while the international system tries to show the most up-to-the-minute value, even if that means it goes back up.
So we've pretty much covered the why, so let's get into the how. How do accountants actually sit down and calculate this loss? Well, it all comes down to that net realizable value we just talked about.
It's a pretty straightforward three-step process. First, you start with the estimated selling price in today's market. Second, you subtract any costs to finish the product, if it's not quite ready. And finally, step 3, you subtract all the costs to actually make the sale. We're talking things like shipping and sales commissions. So let's go back to our smartphone example. Let's say the new market price is $350, but it costs $20 in commissions and shipping to sell each unit.
The math is simple, right? $350 minus $20 in costs, that leaves a net realizable value of $330. Now you compare that to the phone's original cost of $400. Because the NRV is lower, the company has zero choice. The rules require them to recognize a $70 loss on every single phone in their inventory, and they have to do it right now.
Okay, so companies have two ways to put this loss on the books. The direct method is simple. They just lower the inventory's value directly. But honestly, analysts much prefer the allowance method. This way creates a separate account that shows you both the original cost and the write-down, and that gives you a much clearer window into how much of their inventory management thinks is at risk of losing value. It's all about transparency.
All right, this is where things get a little bit counterintuitive. From an investor's point of view, a write-down is obviously bad news, but its effect on some of the key financial ratios can be incredibly misleading. Sometimes, it can actually make a bad situation look good on paper.
Just look at this inventory turnover ratio. It's supposed to measure how fast a company is selling its stock. Well, after a write-down, that ratio often goes up, which makes it seem like business is booming. But it's just an accounting illusion. The ratio is basically cost of goods sold divided by inventory value. The write-down makes the numerator bigger and the denominator smaller, which mathematically gives you a better-looking number. But in reality, that so-called improvement is a signal of failure, the failure to sell products at their full price.
And this has a whole ripple effect across the financials. As you can see here, the current ratio drops, signaling weaker short-term health because the assets are now worth less. The gross margin shrinks, which is a crystal clear sign of lost pricing power. And all the while, that misleading inventory turnover ratio is going up. This is exactly why you cannot look at just one number in isolation. A smart analyst sees these signals together and understands the real, and frankly, troubling story.
Now, because this whole process of estimating future value is, well, subjective, it opens the door for some manipulation. And this is where we get into a little bit of forensic accounting, looking for red flags that suggest management might be playing games with the numbers.
This is such a critical point. Because write-downs involve making estimates about the future, they are by definition subjective. And wherever you find subjectivity, you find an opportunity for manipulation. You got to remember, every write-down tells a story. The real question is whether it's an honest admission of a problem or a carefully crafted piece of fiction.
One of the classic tactics is something called the big bath. So this happens when a company is already having a bad year. Management decides, hey, let's just take all the pain at once, and they write down inventory even more than they probably need to. Why would they do that? Well, it sets an incredibly low bar for the future. It makes the next year's growth look heroic by comparison. It's a move you often see from a new CEO, who can then blame the massive loss on the old regime and set themselves up for a huge comeback story. Now, the opposite tactic is using what we call cookie jar reserves. During the good years, a company might overestimate its future inventory losses, creating this sort of hidden rainy day fund. Then, when a bad quarter comes along, they can just dip into that cookie jar by reversing some of those old provisions. This artificially smooths out their earnings and hides the underlying volatility from investors, making the company look way more stable than it really is.
So why does all this technical accounting stuff even matter? It matters because understanding how and why inventory gets written down gives you a really powerful analytical edge. It lets you see the real story happening behind the reported numbers.
See, when it comes down to it, a write-down is never just some boring accounting entry. It's a powerful diagnostic signal. It tells you about a company's operational efficiency, its real position in the market, its ability to forecast demand, and yeah, as we've seen, it can even reveal the character and the strategy of its leadership.
You should think of a write-down as the point of impact. It's where a company's internal plans and hopes collide with the harsh reality of the external market. And that collision is recorded, right there on the financial statements, for everyone to see. It really does tell a story of past forecasting failures, present market struggles, and it offers a crucial hint about future profitability. It's one of the few numbers you'll find on a page that looks backward, forward, and at the present, all at the exact same time. So I'll leave you with this question. Now that you know the architecture behind that number, the next time you see a company announce a major inventory write-down, are you just going to see a simple loss on an income statement, or are you going to see the entire fascinating story that it's confessing?